Welcome to the deep dive. Today, we're pulling back the curtain on something really quite alarming. Just how incredibly sophisticated and, well, widespread financial fraud has become. Not just here, but globally. It's quite a shocking reality.
It really is. And it seems to be escalating, pretty rapidly. So this deep dive, it's built around a really crucial strategic analysis report from the UAE Financial Intelligence Unit, the UAE FIU. And they dive deep into organized financial fraud.
Okay.
We'll be looking at sort of the latest trends, what enables it, and what the future might hold for this threat.
And this isn't just abstract stuff, right? This report, it's grounded in a huge amount of real-world data. We're talking analysis of thousands of suspicious transaction reports, STRs, and suspicious activity reports, SARs, specifically from, July 2023 to June 2024.
That's right. Plus, they pulled insights from financial institutions themselves, focus groups, even international intelligence. It's pretty comprehensive.
So our mission for you, the listener, is to really unpack the most important bits of knowledge from this big report. We want you to walk away feeling genuinely well-informed on this, understanding the current landscape, who the perpetrators are, how they actually operate.
And the big challenges, yeah, and maybe some solutions for tackling what is a constantly evolving threat. Think of this as your kind of shortcut to getting up to speed on a really critical topic.
Okay, let's start then with the sheer scale. The magnitude of this problem, both globally and right here in the UAE, the report really flags a dramatic worldwide increase in these complex fraud schemes. And I guess it's no surprise, technology is a massive enabler.
Oh, absolutely. The numbers are, well, frankly, they're staggering. Just in 2023, we saw over $3 trillion in illicit funds moving around the global financial system.
3 trillion. Wow.
Yeah, and within that huge number, fraud losses globally were estimated at nearly $500 billion, about $486 billion. That really tells you how dominant these schemes have become, across all sorts of transactions.
That's just an incredible figure. And it gets more specific, too, doesn't it? Like, in the U.S., the Internet Crime Complaint Center, the IC3, they reported something like 758,000 complaints in 2023 alone.
Right. And what's really eye-opening there is how much the financial losses have jumped. It went from about $3.5 billion back in 2019 to, get this, $12.5 billion in 2023.
$12.5 billion just in the U.S.
Yeah. And investment fraud, particularly anything crypto-related, that was the most common type. It accounted for over $4.5 billion in losses just last year. A huge chunk.
And it's not just the U.S., is it?
No, not at all. The UK, for instance, saw over £1 billion in payment scams in 2023. And the World Economic Forum, they reckon that scammers got over $1 trillion from victims globally last year.
$1 trillion.
The key thing to grasp here, I think, is that fraud isn't just some isolated crime. It's very often a core activity for organized crime groups. And it fuels other really serious stuff like human trafficking and, of course, large-scale money laundering.
Okay, so that's the big, scary global picture. Let's bring it closer to home. What does this deep dive tell us about the situation right here in the UAE?
Well, it's definitely seen as a major threat here, too. And it's seen as a major contributor to money laundering activity within the UAE. The numbers really back this up.
Okay.
Fraud-related suspicious activity reports, those STRs and SARs we mentioned, they've surged. They went from around 5,600 cases in the year ending June 2022,
Right.
up to over 9,400 in the year ending June 2024. That's a 57% increase in just the last year looked at.
Wow, a 57% jump. And the financial institutions here, they must be feeling the direct impact.
Oh, absolutely. The report surveyed 41 institutions, and they reported an estimated financial loss of over AED 1.2 billion just between 2021 and 2023.
1.2 billion AED, that's what, roughly 340 million US dollars?
Something like that, yeah. A huge amount. And interestingly, about 2/3 of those lost funds were being moved within the UAE. The other third was heading international.
And are they getting any of it back?
Well, efforts to recall the funds tripled, which is good news, shows they're trying. But the success rates, they varied. Domestically, success actually dipped slightly, down to about 14% in 2023. But internationally, the success rate jumped quite significantly, over 50% in 2023.
Interesting difference there. So why this rapid acceleration in fraud? What's driving this surge?
The report points to a few key things that have kind of created a perfect storm. You've got the really swift shift to digital banking, especially after COVID-19.
Right, everyone went online.
Exactly. Then there's just the sheer simplicity, the ease of online banking now, plus the, frankly, frightening advances in AI and deepfake technology.
Yeah, that's concerning.
And then you layer on the widespread use of social media, plus vulnerabilities in things like instant payment channels. It all comes together.
So it's not just one thing, it's this combination.
Precisely. And maybe the most urgent takeaway here is how readily these, technological advancements are being weaponized. Everyday digital convenience is being turned into this new frontier for exploitation. It's not just more fraud. It feels like a different kind of threat now.
Okay, so given this huge scale and the sophisticated nature of it all, the obvious question is, who are the people behind these schemes? What did the report find most, maybe surprising about the profiles?
It's actually quite fascinating. When you look at the analysis of all those suspicious reports, it gives a pretty clear picture. About 90% of the suspected perpetrators are individuals, natural persons. Only about 10% are companies or legal persons.
90% individuals. Okay.
So yeah, it suggests that while companies are definitely involved, it's overwhelmingly individuals who are flagged in these reports, at least.
And looking at those individuals, is there a particular age group or demographic that stands out?
Absolutely. A really significant chunk, 64%, are in their early 20s to 40s.
So millennials and Gen Z.
Pretty much. Which strongly implies, that these are people highly familiar with modern tech digital platforms. They're heavily involved, whether they're running the schemes or often acting as money mules.
And what about their jobs, their professions? Are we talking about specific backgrounds?
It's quite diverse, actually.
Yeah.
The report mentions blue-collar workers make up about 32% of those involved. Often these are the ones acting as money mules. Maybe knowingly, maybe not. Think about construction workers, for example, with low declared salaries being exploited.
Right.
But then you also see sales and managerial positions each accounting for another 12%. So it's a mix, suggesting maybe some technical skill combined with perhaps the ability to manipulate or persuade.
And what about the 10% that are companies? What kind of businesses are we seeing used?
Right, so for those legal persons, about 10% of the cases involved newly established entities. Most were limited liability companies, LLCs, and they were set up often on the mainland, about 48%, or in free zones, around 15%.
And their licensed activities, anything revealing there?
Yeah, it's quite telling. Common activities listed were things like portal and web designing, social media services, IT, marketing. Even construction shows up again. It hints at how they create this sort of facade, a veneer of legitimate business to cover up the illicit stuff.
Makes sense.
And the report really stresses, these fraudsters, they aren't just amateurs. They seem to have a pretty deep understanding of payment systems, financial institution vulnerabilities. They often operate in organized, hierarchical networks. And a key pattern is routing proceeds of crime from outside the UAE into the UAE for laundering.
Okay, so we have a picture of who's doing it and the scale. Now let's dig into how these schemes actually work, the transaction methods and these key enablers that help the deception along. How's the money actually moving?
Right, so how does the money move? Well, nearly half, 42% to be precise, of all the reported fraudulent transactions involved outward mobile or internet banking transfers. That's the biggest chunk.
Okay, so online banking is key.
Definitely. Other significant modes were inward wire transfers, that's money coming in at 19%, and outward wire transfers, money going out at 12%.
And outside of those sort of traditional bank transfers, are other methods common?
Yes. The financial institutions also reported that simple cash payments, traditional wire transfers again, and also person-to-person apps, P2P apps, are frequently used in these fraud transactions.
Right, like payment apps on your phone.
Exactly. It shows they use a diverse toolkit, leveraging the ease and speed of digital platforms, but also falling back on older methods when needed.
Okay. Now let's talk about these fraud enablers. You mentioned them earlier, the factors that maybe wittingly or unwittingly help these crimes happen. What's the biggest concern highlighted in the report there?
Oh, without a doubt, it's money mules. The report found that a third, 33% of the suspicious reports they examined involved possible mule accounts.
A third! That's huge!
It is. These individuals are absolutely crucial to the whole fraud ecosystem. They receive the dirty money, they move it, they layer it to make it harder to trace. And as we said, often they're blue-collar workers. Sometimes they know what they're doing, sometimes they're tricked, or sometimes it's through this thing called slipper fraud.
Ah, yes, slipper fraud. That sounds interesting. Can you explain that a bit more? What is that?
Yeah, it's quite a clever patient trick. Basically, someone opens a legitimate bank account. They use it normally, maybe for 12 months, maybe 24 months. They build up a clean record, establish trust with the bank.
Okay, looks perfectly normal.
Exactly. Then, after that period, the account is suddenly used for illicit activity. Sometimes the original holder is tricked into giving up control. Sometimes the details are stolen or sold. But because the account has this clean history, it's incredibly difficult for banks to flag it up front as suspicious. It's a long game.
Wow, that is sophisticated. What other enablers did the report point to?
Well, next up is social engineering. And it's important to remember this isn't really a cyber attack itself. It's more about psychological manipulation.
Tricking people, basically.
Right. Getting victims to take risky actions. This covers phishing, those malicious emails we all get. Voice phishing, so phone calls, often sounding urgent, maybe pretending to be the police or your bank, and smishing SMS or text message scams. It's all about exploiting human trust, maybe creating a sense of urgency or fear.
And what about more physical or document-based fraud?
Yeah, fraudulent documents are another key enabler. So forging or altering things like salary certificates, invoices, maybe financial statements, often to get loans or credit they aren't entitled to.
Right.
And identity theft is closely related. Stealing personal info name, date of birth, ID numbers, bank details, and using it to impersonate victims, maybe opening new accounts, applying for loans in their name. And this is often facilitated by that phishing or social engineering we just talked about. It all links together.
And the more purely technical ways they enable fraud?
You also see malicious actors or malware attacks, hacking into accounts, basically, then using that access to make unauthorized payments or steal data.
Okay.
And finally, legal persons companies can be enablers too. Things like shell companies, which have no real operations, just exist to hide ownership. Or front companies, which seem like legitimate businesses but are actually disguising illicit activity. Even clone companies that mimic genuine firms. Or sometimes, legitimate businesses just get tricked into facilitating fraud or might even be complicit.
So that leads us nicely into the actual types of fraud, the patterns that are most common, according to this UAE FE report. And you mentioned they often overlap, which must make them even harder to tackle. Which ones really stood out?
Yeah, the overlap is key. But looking at the most prevalent types, well, phishing, vishing, and smishing are really dominant techniques. And they're often combined with other frauds like business email compromise or impersonation.
Impersonation fraud feels like it's everywhere these days.
Right. It really does. Scammers pretending to be government authorities, the police calling you or your bank or even a trusted supplier, all designed to get sensitive information out of you.
Right.
Then there's business email compromise, BEC. This is a really sophisticated type of payment diversion fraud. They compromise a business email account, maybe a finance person's account,
Okay.
and then use that access to alter payment instructions. Send an email saying, pay this invoice to this new bank account. What's really striking about BEC is how often it relies more on clever social engineering than pure technical hacking. Maybe using a slightly altered email domain name that looks very similar, or attaching forged documents.
So subtle changes that are easy to miss if you're busy.
Exactly. And very often those money mules we discussed are involved in receiving the diverted funds from BEC scams.
It's amazing how effective something seemingly small, like one letter changed in an email address, can be. What else is common?
We also see a lot of fake online marketplace and shopping scams, fraudsters setting up fake websites or maybe social media accounts, selling goods that just don't exist.
Like what kind of goods?
Could be anything, really. Fake concert tickets are common, especially for popular events. Fake online courses, maybe counterfeit versions of cult fashion brands or electronics. Victims pay, often up front, and then nothing arrives. And these are often combined with impersonating well-known, trusted brands to lure people in.
And what about the more direct attacks on our bank accounts?
Account takeover is a really big one. That's where fraudsters gain unauthorized access to your actual bank account to move funds out. It's a form of identity theft, really.
How do they manage that?
Usually through things like phishing, tricking you into giving up your login details, or SIM swapping. That's where they gain control of your mobile phone number, often by tricking the phone company so they can intercept security codes sent by text message. Or sometimes just using credentials stolen in data breaches elsewhere.
Scary stuff.
It is. And unfortunately, the older methods haven't gone away either. ATM or card skimming fraud, using those physical skimmer devices attached to ATMs or payment terminals to capture your card details, that still persists.
Okay, so we've covered the scale, the who, the how, the enablers, the types. With all these complex, evolving schemes, What are the biggest challenges financial institutions face in actually tackling fraud? And importantly, what solutions are being proposed?
Well, the report makes it pretty clear that FIs are struggling. Over 60% said they find it difficult to tackle new, emerging fraud schemes, and just the sheer volume of suspicious transactions they have to sift through every day.
That's understandable.
And then there's the cost. Implementing and maintaining advanced technology and security controls isn't cheap, so you have significant operational hurdles, technical challenges, and cost barriers for many institutions.
So, given those challenges, what's seen as the top solution? What are the experts recommending?
The number one suggestion is investment in technology, specifically implementing AI-driven analytics.
AI again.
Yeah, using AI to spot subtle patterns in transactions, identify anomalies that humans might miss, and, crucially, adapt quickly to new fraud tactics as they emerge. There's also talk of exploring things like blockchain for creating more transparent, immutable records and for more robust digital identity verification.
And what about the more immediate defenses? Things institutions and maybe even individuals can do right now?
Enhanced monitoring and authentication are absolutely crucial. This means real-time monitoring systems that can flag and potentially block suspicious transactions as they happen, and moving beyond just passwords or basic one-time passcodes.
Right, those seem increasingly easy to bypass.
Exactly. The push is towards stronger multi-factor authentication using things like biometrics, fingerprints, facial recognition, or perhaps device recognition, maybe even IBAN verification to make sure the account name matches the number. AI is also being looked at for authenticating documents more effectively, spotting those forgeries we talked about.
And for all of this tech and monitoring to actually work, it sounds like speed and just general awareness are key.
They're absolutely vital. Prioritizing swift reporting of suspected fraud is critical. Time is genuinely of the essence to try and recover funds before they get laundered and disappear.
Makes sense.
Equally important is staff training. Regular, up-to-date training for frontline staff on the latest fraud tactics they might encounter. And, of course, educating the public, educating customers like you about common scams and how to protect yourself. Awareness is a huge part of prevention.
And finally, what about working together? Is there a role for more collaboration?
A huge role. Collaboration and information sharing are seen as key solutions. Things like industry-wide consortiums, where financial institutions can securely share anonymized fraud information amongst themselves.
So they can spot patterns across different banks.
Exactly. And stronger collaboration between the financial institutions and the regulatory bodies, like the UAE SEU itself. The report also calls for things like an integrated fraud registry and maybe standardized rulebooks across the industry to help identify those emerging trends more effectively and consistently.
Okay. All this intelligence gathering, the analysis, it leads, as you mentioned, to the development of specific risk indicators. The UAE FIU has compiled, over 60 of them to help detect potential fraud. Can you give us a flavor of the kinds of things we should be looking out for, maybe starting with transaction patterns?
Sure. So for transactional patterns, some red flags might be, say, an account that's been dormant for ages suddenly becoming active with unusually large or frequent transactions.
Okay.
Or a sudden high volume of remittances coming in from overseas, maybe from high-risk countries. Or seeing multiple cash withdrawals from ATMs that are geographically distant from each other in a short space of time. Any sudden unexplained increase in online or mobile transactions compared to the customer's history. Or even a pattern of SWIFT recalls hitting the same beneficiary account that's where money is sent, and then quickly an attempt is made to recall it, which can sometimes indicate testing the waters or moving illicit funds.
Interesting. What about human behavior? Are there behavioral indicators that should raise suspicion?
Definitely. Things like a customer giving insufficient or vague justification for the source of funds coming into their account, or accounts being accessed repeatedly from unusual IP addresses or multiple geographical locations in quick succession.
Right.
Sudden changes to a user's online profile or personal information right before suspicious transactions happen. A high number of failed login attempts could indicate someone trying to brute force access, or even a customer actively refusing standard ID verification requests, or rejecting the use of multi-factor authentication when offered. That could be suspicious.
And what about inconsistencies in the information provided? Things that just don't add up?
Yeah, this is a big category. Look out for documents like IDs, contracts, invoices that have obvious discrepancies, maybe spelling errors, weird fonts, text that doesn't line up properly.
Simple mistakes, but telling.
It's exactly a mismatch between the beneficiary name provided for a transfer and the actual name on the destination account. Inconsistencies in ID documents presented during those Know Your Customer or KYC checks that banks do. Or maybe someone's declared salary seems wildly inconsistent with their stated employer or profession. Even seeing a personal bank account being used heavily for what look like business transactions can be a red flag.
Okay. And finally, with cryptocurrency being so prominent now, are there specific risk indicators related to crypto activities?
Yes, definitely. Crypto has its own set of potential warning signs. Things like transactions involving unlicensed or completely unknown virtual asset service providers.
So dodgy exchanges, basically.
Pretty much. Or unusually large crypto transfers that just don't fit with a customer's normal financial behavior or profile. Seeing funds arriving from multiple, seemingly unrelated third parties and then being quickly transferred out to crypto exchanges. Or maybe the use of multiple different credit or debit cards, often under different names, to purchase cryptocurrency. These can all signal potential fraud or money laundering activity involving crypto.
Okay, those indicators are really helpful. To really bring this all to life, the report includes a couple of case examples. Can you walk us through the first one, the one involving crypto fraud?
Sure. This case really illustrates how proceeds from crypto-related fraud get laundered. They identified a subject A who was the founder of a fraudulent crypto platform based overseas.
Okay.
This individual then strategically opened multiple accounts here in the UAE, personal accounts, business accounts, and even set up some shell entities.
And what did the money flows look like? How did they move the illicit funds?
Well, the UAE's analysis showed these really complex circular transactions. Funds were coming in from lots of different, apparently unrelated third parties. Then the money was meticulously moved around, layered between subject A's various personal and business accounts within the UAE.
Trying to muddy the waters.
Exactly. Then those funds were wired internationally. And ultimately, the money was used to buy high-value items, luxury cars, expensive watches, real estate. What's crucial here isn't just how they move the money, but how they use the appearance of legitimate business activity and these high-value assets to try and clean the illicit gains. It makes detection incredibly hard until often it's too late.
That's a perfect example of hiding the trail in plain sight, almost. What about the second case? That one involved money mules, right?
Yes, the second case focuses on laundering the proceeds of fraud committed outside the UAE, but using money mules based inside the UAE. In this instance, a company C was defrauded by two foreign companies, let's call them A and B, through a business email compromise scam. We're talking millions in losses.
Okay, so a classic BEC scam originating abroad.
Right. But the key twist was how they laundered the money. They specifically recruited multiple money mules and set up new shell companies in the UAE just to receive these foreign fraudulent proceeds.
So the UAE became the hub for washing this dirty money. What happened to the funds once they arrived?
Exactly. The funds were then rapidly circulated and layered among these various suspected mule accounts and shell companies within the UAE, and then, almost immediately, withdrawn primarily as cash or bank checks.
Getting it out quickly.
Precisely. Showing a clear intent to obscure the money's origin and get it out of the formal system as fast as possible. And further investigation actually uncovered that a specific individual, Individual X, who was part of a foreign organized crime group, had been impersonating other people to get the initial bank accounts opened for companies A and B back in their home country.
Wow.
It just demonstrates how these organized groups leverage individuals, shell companies, and operate across borders to facilitate their crimes and make tracing the funds incredibly difficult.
So wrapping this all up then, this deep dive really hammers home that financial fraud isn't some simple or static threat. It's complex, it's global, it's constantly evolving, deeply tied into money laundering.
And heavily driven by technology, yes, but also by sophisticated organized criminal groups.
And being well-informed, understanding these intricate schemes, the enablers, those risk indicators we talked about, it isn't just academic. It feels like a genuinely powerful step anyone can take to help counter fraud, both personally and maybe pushing for institutional change, too. Public vigilance, public awareness seems just as crucial as anything the banks or law enforcement can do.
Absolutely. And maybe that leaves us and you, the listener, with a final thought to chew on. In a world where this kind of deception is becoming increasingly automated, networked across the globe, how can we foster a kind of collective intelligence, something that goes beyond just the institutions, to help us all stay one step ahead of those who are trying to exploit trust and vulnerability?
What more can you learn or perhaps share to make yourself and maybe your community just that little bit more resilient against these often unseen threats? Something to think about?